Wednesday. Welcome, welcome, everybody. The United States Senate Federal Credit Union team is very, very happy to host you this evening in another weekly Wednesday webinar. And as you can see on the screen, is your financial house in order? We're gonna go over the topic if your finances are looking the way they're supposed to. What can you do to improve them? And if there's any other tricks that you can take from this presentation and tips as well. My name is Eddie Villanueva. I'm the Member Engagement Specialist here with the U.S. Senate Federal Credit Union. And I just want to say thank you again for being here with us. Just relax, go get you some coffee, get you some water. You're having dinner. Bon appetit as well to you. But, we're just going to give a couple more minutes for people to join. But thank you very much for being here with us. We're so, so grateful. And as usual, please make sure that you stay interactive with us. Send us questions through the chat using the Q&A feature, whether it's related to the topic or if you have any general questions about your account or the credit union, well, not your specific account, but our products and services, please let us know and we'll be glad to answer them. Because Andrea Londono, what is the commitment every single week?
That we're going to answer each and every one of your questions.
That excitement made me realize that I need to send like 20 questions now. I'm so happy, So thank you very much once again for being here with us. And I see a lot of familiar names on the attendee list. So if you've been here with us before, thank you for being here with us again. And if you are new to that weekly Wednesday webinars, welcome. We're so glad to have you here. And with that being said, I believe that it's time to do the introductions so you can, know a little bit more about the faces that you see on camera, also the ones behind the camera. So because there's people going, doing, working some things behind the camera, just like the graphics that you see. But I'm not going to get ahead of myself. I will pass on the mic to Milton Aguilar Bolanos, our Membership Development Officer, with the introductions. Milton, take it away.
Hey, Eddie. Thank you so much, sir. And you almost made me get out of my chair and drive to Starbucks when you say go ahead and grab your drink. This is our first webinar of October, technically the fall. So we all know that those pumpkin spice lattes or anything with a pumpkin is the season right now. So yeah, but I forgot. I remember that I need to be in this webinar, so that's the reason why I didn't leave my share. But I was tempted. I was very tempted, Eddie. But with that being said, we want to welcome everyone again. And as Eddie alluded to, we just want to thank you for making time out of your busy schedule. And you giving us the opportunity to come in and learn something new, perhaps, or maybe just learn new information that you might see that can be useful down the road for you or your loved ones. So again, thank you all for joining us. With that being said, we do want to be mindful of everyone's time. But as always, as Eddie and Andrea stated at the beginning, it is our commitment that we want to answer every question that you have, and we will answer those before we let you go, this evening. And if we don't have an answer, you better believe that we're going to try to get an answer for you as soon as possible, and then get back to you within 24 hours. So again, that is the commitment that we have. So I encourage you all to be interactive in this presentation. So make sure that you use the chat feature or the Q&A, either one of those options. And our wonderful team from the marketing team will be keeping up with those questions that you submit through the chat or the Q&A. And with that being said, it's a great segue to introduce the panel of all familiar faces. Without any particular order, Andrea Londono from the marketing department, who again is going to be keeping track of the Q&A and the chat. Also, Assistant Andrea, it's our very own, the face of the credit union column, Eddie Villanueva, from our marketing team as well. And the person that I know you haven't seen her in camera, it's been a couple of days now, but because she's running everything behind the scenes for us, the person in charge of putting all these beautiful graphics, Carrie Lazar, also from the marketing department. She is running the presentation, and as you can see, the mouse is moving. So that's Carrie. Hey, Carrie. So again, thank you so much. And one of the things that Eddie always says about these presentations that we put together is actually, believe it or not, it's organic content. This is something that we put from scratch. and we are very proud of the work that Carrie does for us. And most important, we are definitely grateful. And as Eddie alluded to, my name is Milton, and I'm the Membership Development Officer here for the credit union. And I'm really delighted and happy to be part of this amazing panel. And with that being said, it is time to hand it over to what was the word Eddie used this morning? The woman of the hour, is that what you say this morning, Eddie? I can't recall exactly your own words, but I'm going to hand it over to my very own, my colleague, my right hand, Kim Friedley from the Membership Development team as well, as she is going to be leading this presentation. So Kim, go ahead and take it away from us.
Thank you guys so much, and welcome everyone to this week's Wednesday webinar, Is Your Financial House in Order? We are so excited to offer you this webinar. It's getting ready to be the holiday season. Your house might be organized. It might be just ready for everything, but we're going to talk about your financial house and is it in order? And it was a perfect segue when Milton said he was about to jump out of his seat and go to Starbucks. We're actually going to talk about that. We're going to talk about not getting out of your seat, not going and buying that expensive coffee, and how that can impact your financial future. So let me turn my camera off and we will get started. So during tonight's session, we're going to discuss tips on how to make sure your financial house is in order and to ensure that you're taking the steps needed today to secure your retirement tomorrow. We're going to begin by discussing your financial situation and talk about key tools like talk about budgeting. We're going to talk about debt management, if that's a need that you have. And then we're going to explore ways that you can protect your assets. We work our entire lives for our assets. We want to make sure that they are protected, prepare for retirement, and create that financial legacy for those people that you love. So the first area to focus on is your current financial situation. So in the next few slides, we're going to cover how to organize your financial paperwork. We're going to talk about the importance of reviewing your current income and your current expenses by doing a detailed analysis so that you can really identify areas where you may want to make changes and improvements. We're going to talk about budgeting and establishing an emergency fund. So, organizing financial paperwork. You can see that in front of you. These are actually the what we recommend. First of all, you've got to get your financial paper organized. That's a great way to start to begin on your path towards financial wellness. But before you throw away, those receipts, those bills, you definitely want to have some things that are worth hanging on to. So you can see in front of you 1 year. To keep for 1 year, you're going to want to keep bank statements, pay stubs, quarterly statements, canceled checks. If you still write checks, you're going to want to hold on to these items for 7 years. You're going to want to hold your income tax returns, records of selling a house or stock. That's documentation for capital gains tax. While you have these policies active, your insurance papers, your vehicle loan documents, your mortgage documents, your retirement plans, your warranty info, and eventually you can shred receipts, utility, and credit card bills. You're really going to want to make sure these things are organized just in case something were, God forbid, to happen to you. Next slide is, a key element to a better financial future is really saving more now. I wish I would have had this in my younger life, when I was my younger self. I would be in a much different place today if I had. So it's a great time to really give you the tools, the tips, the resources, and you can share them. You can share them with your family. You can share them with the younger generation. And one of the best ways to accomplish this is really by creating a budget. I know it's a daunting task, but if you have not done that, that is going to be your first step. Even if you already have, and you're a person, a budget-oriented person, it's still always a really good practice to revisit, kind of fine-tune it, and enhance it on a regular basis, because we all know that things change and they can change in an instant. So in its simplest form, a budget includes a breakdown of your income and your expenses. And we'll discuss in a moment. As we'll discuss in a moment, you may even find opportunities to trim certain expenses so that you can free up more money to save for things like, buying a home. You might need to save for college, retirement planning. So what does a good budget allow you to do? Well, in particular, it allows you to keep track of your spending. That's the biggest eye-opening thing. It helps to manage or eliminate your debt. Again, that's always so helpful, and it just makes you feel so successful when you start paying down your debt. It helps you curb your impulse purchases. Somebody on here wanted to get out of their seat and run to Starbucks. So it also helps determine expenses in retirement, and it can also help you realize that you can increase your savings for longer term financial goals. So managing income and expenses. So one of the first steps of debt management is getting organized and tracking your income versus your expenses. So we have this budgeting worksheet. We're going to link it in the chat for you. If you don't already have a budget worksheet, this one is pre-fillable. It's wonderful. It's going to really show you everything in one page. So you're going to take a few minutes to look at the monthly income and expense. You're going to take a minute to review the top half concerning employment income and any other income that you have. And we highly encourage you to fill this out. So we're going to give you some examples of what other income could be. It could be things like child support, gifts, if you're so fortunate that someone is going to gift you money. It could be your tax return. It could be help from a family member, seasonal work. We're getting ready to go into winter. Maybe you plow snow, disability wages, financial support from the government if you get that. Just some things to let you know what other income is. And you're going to want to include that as well. So this will help you get a total picture of your income and financial resources. So after completing the top sections, then you're going to want to think about where your money goes. And to complete this section, you'll need, of course, receipts and your bill statements for the last month. If you pay your bills online, it's fine. You can just easily look at your online records and just jot them down. And to truly get a good picture of your spending, we're going to encourage you to keep an envelope for all your receipts for an entire month. And what that means is you're going to have an envelope for gas. Every time you get gas, you're going to put that receipt into that envelope. You're going to have a receipt for eating out. Every single time you eat out, and not just eating out, every single time you go through Starbucks and just get a coffee, every time you go through Chick-fil-A and just get a milkshake, or every time you go through McDonald's and just get a soda, every single receipt, because believe it or not, little by little, a little becomes a lot. It truly does. So you're going to keep these receipts, even your grocery shopping. So you're going to have an envelope for groceries. You're going to have an envelope for entertainment. So if you go to the movies, and then you're going to add all those receipts to your envelopes. And then at the end of the month, you're going to add them all up and you're going to revisit this form. and make sure it's accurately portraying your spending habits. It's going to be very eye-opening. After you complete the form, then you're going to go back to each item and just check off whether or not you receive that income or have that same expense in retirement, because there's a big difference in your income now compared to when you actually retire. Managing debt. So, managing debt also is going to play a role in a budget and can help lower your debt to income ratio. The best thing for you to do for your budget is to start paying off debt now, especially where there are high interest rates. We had a webinar, I don't know if it was last week or the week before. The nation's average credit card rate is like 28 point something. It's almost 30%. So you're going to want to start, if you have those high credit card interest rates, you're going to start there. And if you have a lot of them, it's always good to consolidate where possible. And right now we have excellent credit card rates, 13.5% for our Smart Rate, 14.5% for our Smart Reward. And those rates may soon come down. So you're also going to want to know that not all debt is bad. For example, having a mortgage, that actually tells creditors that you are responsible in a potentially low credit risk. So having credit, but managing it responsibly. And what that means is really a low debt to credit ratio. So if you have a credit card for $10,000, you're going to want to make sure that you don't have more than a 30% balance compared to that limit. And that's also goes into your FICO scoring. So that's a win-win if you keep it within that range. So here are a few strategies to think about related to managing and reducing debt. Start by making extra payments to your credit cards creditor with the highest interest rates. By paying these debts off sooner, you will be able to put more money away for the future. And that's our goal, isn't it? To have be financially well in our older years. And when you get a pay raise or you get a bonus, use a portion of that to pay down your outstanding debt. You are going to, if you have worked with a lender for a while, you may be able to negotiate the interest you pay on those higher rate credit cards. It doesn't hurt to ask. And then pay off one card, put the money used to pay toward that card toward another card. It's kind of like a domino effect, and you're going to pay it down faster. Freeze credit card spending. Only buy what you have cash to purchase, and reduce variable expenses, as we previously discussed, and redirect that spending to increase monthly payments to other debt. Securing your financial future. So let's actually talk about prioritizing savings. What you need savings for. Everyone is going to need an emergency fund. Emergency fund is typically 3 months of your mortgage, whatever utilities, because we all know, especially after the last couple weeks with Hurricane Helene, things happen. All of the people that have lost everything, did they have an emergency fund? And it doesn't always have to be something that drastic. It could be that, you get hurt on the job, and it's going to be a while before you get that first disability, short-term disability payment or FMLA. You're going to want to make sure you have that emergency fund, and you're going to want to make sure that that emergency fund is available to you. So you're going to want to put it in a savings account. You can name it household, you can name it emergency fund, put it in a money market where you could earn a little more interest on that money. You're not going to want to lock it into anything, so that when that emergency takes place, you are able to get that money right then and there. And then you're also going to want to make sure that you look at your health insurance. You're going to want to make sure that you know exactly what your policy does for you. You're going to want to make sure that You look at retirement, what it's going to cost you in retirement. We all know that while you're working, you have that great health insurance policy, but when you retire, it actually, all of that's going to completely change. So it's really important that you prioritize your savings and caring for your family. You're going to want to make sure that you have everything in place. We have fellows, we work with fellows. They can help you with, estate planning. They can help you with, you definitely want to make sure that you have a will. We talked about protecting your assets that you work so hard for, and securing your financial future. Take advantage of available resources. We have all kinds for you here at the credit union. With fellows, seek professional guidance, take an active role, avoid cashing out early. What you want to do in order to secure your financial future, and we've said this several times, you want to start saving more now. And one of the best ways to do that is by eliminating things that you actually don't need. So you have in front of you, the slide in front of you is all about pre-tax, after-tax, potentially income tax-free. So pre-tax company-sponsored retirement plans, 401ks, 403bs, 457bs, pension plans, individual retirement accounts, simplified employee pension. After-tax dollars are savings accounts, certificates of deposit, mutual funds, annuities, real estate, and then potentially things that could be income tax-free are things like tax-exempt bonds, funds, educational savings accounts, life insurance, death benefits, Roth IRAs, Roth accounts and company sponsor plans, and some 529 plans. So those are the things that you're going to want to look at as far as, your actual, what you're going to have to pay. That's going to be part of your expenses. And then it's also going to be part of your actual income in retirement. So those are things that you're definitely going to want to look at to help you get to the place where you want to be. The next slide, we are going to talk about, imagine if you saved this much each week. To me, this is so very eye-opening. $25, $75, and $125. And I think automatically as to how much I spend when I go to places like Target or TJ Maxx. You go in for one thing and you come out and it's $300 later. So look at this rate of return. This is compounded on a 4% rate of return over 25 years. So just look at $25. You could have $55,237 if you saved $75, compounded 4% rate of return, $165,709, and $125 a week for 25 years. Look at that amount right there. Some of you are probably that financially savvy and may have even done that yourself. Like I said earlier, I truly wish that I had, this type of webinar in my younger life. So you're going to want to make sure that one way to possibly pay yourself first is through a company-sponsored retirement plan, such as a 401k. You're definitely not ever going to want to leave money on the table. So while you're working, make sure you take advantage of everything that you possibly can. And you might even want to invest in mutual fund companies because they offer a feature called systematic investments, whereby a certain amount of money is withdrawn from the investor's bank savings or checking, such as monthly or quarterly, and used to purchase shares of a mutual fund. This is something my husband actually does. So another, resource, another way for you to be financially well. So let's talk about how important financial checkups are. protect yourself by performing financial checkups. If you oversee the family's finances, it's an awesome responsibility, but it can also be very stressful. And in addition to providing your family with the basic necessities of life, you may feel responsible for their overall financial well-being. So one of the best ways to care for your family is to be sure that you are prepared if something were to ever happen to you or another member of your family. So performing a health insurance checkup, you're going to find out exactly what services are covered as part of your health insurance. Ask if there's limits on medical tests. You're going to want to ask if there's out of hospital, if there's a price for out of hospital care as well. Just make sure that you don't just accept a policy, that you know exactly what that policy is going to do for you. Property and casualty insurance, we just talked about the Hurricane Helene. You're going to want to make sure that you know exactly what your homeowner's insurance does for you. You're going to want to know what your auto insurance does for you. Don't just call Geico and say, I need, home insurance policy. Make sure that you read exactly what that policy does for you, just in case something horrific like that were to ever happen. It's really, really very, very critical. So you want to make sure that you also have, if you could go right back to that prior slide, sorry, that you have adequate life insurance. The life insurance coverage, sometimes your employer offers that, but it might not be enough. So realistically, try to determine how much life insurance you need. And then we recommend that you shop around. Term insurance is the most affordable type of life insurance. Just be sure that the term lasts to meet your needs. Make sure it lasts to the age that you think you're going to need it, or until your children are financially self-sufficient. And don't overlook disability insurance, income insurance. At any given age, your chances of becoming disabled are higher than your chances of dying. So if your employer does not offer disability insurance, you're going to want to definitely purchase a plan somewhere else. So, and then we talked about protecting your assets. We work our entire lives for those assets. You don't need to have a lot of assets to need a will. Most importantly, you need a will that, names a guardian if you have children. State law determines how your assets will be distributed if you don't, and that's the last thing you want. They're not going to make the decision that you would want made if something were to happen to you. And make sure you keep that will in a secure location, such as a fireproof filing cabinet. If your loved ones cannot find that will, it's no good. So you're going to want to make sure that you let them know where it is and make sure that it is in a safe place. So now we're going to talk about disability income insurance. So according to Social Security Administration, 25% of today's 20-year-olds will become disabled before they retire. That is 1 in 4 people. So, disability income insurance, also known simply as disability insurance, it provides really a steady stream of income if you were to lose your ability to earn a living due to a qualifying disability. There are 2 forms of coverage. There's short-term disability and there's long-term disability. Short-term disability replaces a percentage of your income for up to 3 months in most cases, but it can vary. And then the long-term disability typically covers 40 to 60% of your pre-tax base salary, and it could last a whole lot longer. most policies typically replace up to 60 to 70% of your salary until you get back to work. If this is not enough for you, you don't need to secure additional coverage, but people may need to replace more than this. So your company may offer some form of disability insurance, but if your personal situation dictates a need, which may you may want to supplement it with another one or an additional protection. And we talked about that. You're going to be able to discern that by that budget that you are going to fill out. So in general, when securing disability insurance, there are major differences in policies to consider. There are, the definition of disability. You're going to want to know the waiting period, how long before receiving the benefits. That is so important to know. The length of coverage, how long you receive the benefits, and inflation adjustment. Present and future costs. A few policies guarantee that the insurance cost will not increase in the future. So important to be able to know all of those features and benefits. So now let's talk about planning for retirement and factors to consider. When you think about your budget and our discussion around expenses that continue into retirement, at a time when income is generally less, we start to form a picture of what income level we may need in retirement to achieve the lifestyle that we're looking for. If you're the type that you just want to sit, on the front porch and rock in your rocking chair and drink coffee, you're probably not going to need as much. But if your retirement plans is to move to Florida to that, over 55 resort where it's a party all day and all night, you're probably going to need a little bit more. So let's drill down a little bit further and talk about how much a person may need to maintain your lifestyle in retirement. The actual percentage depends on a number of factors that you're going to want to consider. One is the lifestyle you want when you retire, your retirement age, how old are you going to be, your Social Security benefits, and when you elect to take them. We're going to talk a little bit more about that in another slide. Your company pension benefits, if you have that. The rate of inflation is so important to look at, and income tax rates. And lastly, but most importantly, your health. It's very important to plan carefully to ensure you have enough retirement income to get you through a long and healthy retirement. And isn't that always our goal? We work hard our whole lives, and all we want is to be financially financially well and healthy when we retire so that we can enjoy it. So to accomplish this, you need to ensure your retirement strategy accounts for inflation and rising costs in both fixed and discretionary expenses, and includes investments, with growth potential to help cover the rising cost and taxes. Another key consideration for retirees is the cost of medical expenses. As we get older, our medical expenses generally rise. Unfortunately, they just do. So next, you'll want to have a retirement plan that accounts for those rising costs. Even with moderate inflation over time, fixed and discretionary expenses are likely to rise. Over the past decade, we've had relatively low inflation ranging from 2% to 4%, yet with an annual inflation rate of 3%. So it will take $1.03 next year to buy what $1 will buy today. And that might not seem like much, but over 20 years, a 3% inflation rate can reduce the purchasing power of $1 to 55 cents. That is a loss of nearly half of your purchasing power. So therefore, you really should consider including investments with growth potential in your retirement strategy. That's going to actually help with those rising costs, as well as to cover taxes. And the chart on this slide assumes a 3.5 annual inflation rate over time. So rising medical costs. It's something that we absolutely have to talk about. You know, another key consideration for retirees is the cost of medical expenses. As people get older, their medical expenses often go up, and medical cost inflation, we all know, has been much higher than inflation for other items. You know, out-of-pocket healthcare costs, specifically premiums, deductibles, other out-of-pocket expenses, you know, get this, could exceed $318,000 for a retired couple. $318,000 for a retired couple. That's a lot of money. Only 55% of adults ages 50 to 64 are confident that they can afford the cost of healthcare in retirement. I'm going to read that again. Only 55% of adults ages 50 to 64 are confident that they can afford the cost of health care in retirement. So the time to start saving for this is now. Making SMART goals. I've always used the SMART goal system, personally and professionally. You know, we know that it means specific, measurable, achievable, relevant, and timely. So you are going to want to develop, you know, a retirement plan, and do it by setting SMART goals, and be very, very specific. So you can see, the budget tool that we covered on slide 5, the importance of revisiting it over time because life changes. So you're definitely going to want to reference that budget plan that you have. Don't just do it on January 1st and just leave it until December 31st, because goals that can change over time can be things like housing, college education, vacation homes, travel, and again, the big word of the night, retirement. So diversify your accounts. Another key to a successful plan is to diversify your assets. So we're going to review 2 examples on this next slide. One is a non-diversified portfolio, and the other is a diversified portfolio. So as you can see in the first non-diversified example, the individual has 100% of his assets in cash or cash equivalents and none in the stock market. So, sorry, bear with me just a second. So while his money is not subject to market risk, it is actually subject to inflationary risk because the account generally will not earn enough to outpace inflation to allow the individual to gain that purchasing power. So it is smart to have some assets in cash as part of an overall diversification strategy or to fund short-term goals. But having everything invested in cash is not really good for the long term. And we're going to talk more about that in a later slide, in just a few slides. So let's look at the non-diversified example. The individual has 100% of her assets invested in stocks and none in cash. This person's money is going to be subject to market risk to a much greater degree than the all cash example. She has the potential for a much greater return, but she will likely experience very drastic peaks and valleys as her account balance follows market fluctuations year in and year out. So if an individual risk tolerance is such that he or she can actually experience the fluctuations of the stock market, it's really smart to have a portion of your assets invested in stocks, but having 100% really truly carries a whole lot of risk. So in the diversified example to the right, you can see this person has her assets invested in a mix. They have it invested in cash, bonds, and stocks. So depending on one's risk tolerance, the investment goals that you have, a mix of different types of assets classes will generally help take advantage of different performing markets. It could minimize fluctuation, and it could reach established goals. So it's really important to note that there is no assurance a diversified portfolio will perform better than a non-diversified portfolio. Strategies such as asset allocation or diversification will not ensure a profit or protect against loss. The key here is to find the right balance that works for you and what your goals and strategies are. Keep on investing. Always think long term. It's important to keep investing through all market cycles. Over 1 year periods, the market can be so unpredictable. So if you have little tolerance for loss, or if you need money really quickly, you probably should not include a lot of stocks in your asset allocation plan. Now, if you expand your time horizon to 5 years or more, volatility may decrease, significantly. All right, Social Security maximization. So let's talk Social Security. So here's the $1 million question of the day. When should a person take Social Security? Delaying the benefit in order to increase the payment is not always the answer. So we're going to look at examples of breakdown points based on the age one decides to take Social Security benefits. None of us know for sure how long we'll actually live, but let's make assumptions for the purposes of our example. And for those that expect to live beyond their life expectancy, it may make sense to delay taking Social Security benefits. So let's assume that a person will receive a 3% cost adjustment every year. So taking distributions at age 62, assuming a payment, let's say it's around $1,500, you can see in front of you the total Social Security benefit at age 95 is going to be $1,039,143. Assuming a person takes the distribution at age 66, assuming a payment of $2,000, the total Social Security benefit at age 95, you can see in front of you, it goes up $1,285,117. And then you can see if they take it at 70, assuming a payment of $2,640, the total Social Security benefit at age 95 goes significantly higher to about $1.5 million. Even if one doesn't live to 95, it still may make sense to delay the benefits. If a person delays taking distributions until, let's say, 66 instead of 62 and lives past age 76, he or she will receive more Social Security benefits. If they take it at 70 instead of 62 and they live past age 79, again, they're going to receive more Social Security benefits. 70 instead of 66 and lives past age 81, again, they're going to receive more Social Security benefits. The longer one lives past those break-even points, the more benefits he or she will receive. All right, let's talk about estate planning. So hopefully our careful planning in the areas we've already discussed, it's going to allow you to amass more wealth than you can spend in your lifetime. That's our goal, right? So therefore, you're going to need to plan for an orderly distribution of your estate. The goal here is to minimize your estate taxes and fund those we cannot eliminate altogether. Can't always eliminate taxes. especially estate taxes. So estate planning is not just about taxes and how to reduce them. It's also about making sure that your assets are distributed exactly how you want them to be and who you want them to go to. So you're going to ask yourself these questions. Who should inherit your assets? Which assets should they inherit? When and how should they inherit the assets? Who should be guardian for minor children or family members with special needs? Excuse me. Who should make healthcare and financial decisions if you become disabled? Are family members capable of managing assets after your death? If not, who are you going to have? What will happen to your family business if you have a family business? Will your estate owe estate taxes? If so, how can they possibly be reduced? And there's a couple additional questions that you'll want to consider. If you have minor children or a family member with special needs, who should be appointed guardian? This is a key decision that you should not ever leave to the courts. A child with special needs may need care for many years, and a special needs trust may be needed so that government benefits can still be awarded to that child and aren't lost. So if you become disabled or incapacitated, who do you want to take care of you and make those decisions for you? Will you have enough income if you were to become unable to work? Those are the questions that you're going to want to ask yourself. Assemble a financial team. You know, managing your finances can be like putting together a puzzle. If you all like to put puzzles together, you know all the pieces need to fit in order for it to come together. It's no different. And this is going to give you the big picture, you know, working with one or more of these financial professionals can help put the pieces into place and give you that peace of mind that you want, you know, regardless of your stage in life, whether you're just out of college or entering retirement, most everyone can benefit from the help of a trusted financial professional, financial advisor, or financial planner. And tax advisors provide tax advice and assistance to help you to navigate, to know, you know, where you can have those strategic tax plans and eliminate some of those taxes. And if you're struggling with debt payments, credit counseling can also help. So, you know that we offer that service as well through the credit union. The next slide, this is Michael Schimmel. If you were on our call 2 weeks ago, Michael presented for us, and we partner with fellows. So as a member, you do get a free consultation. They can give you, you know, goal-based financial planning, investment advisory services, retirement planning, estate and legacy planning, personal insurance, and small business planning. So please utilize that resource if you can or if you need to. And then that's me, Kimberly Fridley, Membership Development Analyst, and Milton. We've already introduced ourselves in the beginning. So if you need anything at all, you know that you can dial that 800 number, choose option 7, say Kim Fridley, and I'll be more than happy to help you with any financial need that you have. I really hope that this was beneficial to you. As you know, this was recorded. We will put that out on our website in a day or two, and we will also email you the PowerPoint presentation that we did tonight. I know it was a lot of information, so let's go straight to our questions.
Thank you so much, Kim. What a great presentation. So the first question is, will the handout from the webinar be emailed?
Yes. Great question.
And the second one is, how do you identify financial planning teams that are not racially biased, even when they think they are fair and unbiased?
Milton, you want to take that one?
Sure. Can you go ahead and repeat the question again, Andrea?
How do you identify financial planning teams that are not racially biased, even when they think they are fair and unbiased?
Ooh, that's a tough question. I mean, I guess you know that you gotta get into a very sensitive topic in there, especially when you're talking about race. I mean, but one of the things that I'll definitely say, you know, now especially nowadays, just about every legitimate business, you can go and check their profiles on their the bidder the business bureau. I can't remember the whole name, but in essence, there's a way for you to go and check their you know what reviews, what they have, and whatnot. But obviously, you know, key to that is when selecting your team when it comes to you know putting together all your finances and think about retirement. You know, this is something that you know we as an individual we have to do our research, we have to do our homework, and make sure that you know that you talk to your peers, family members. This is the great time, you know, to have those type of conversations, especially you know if someone you know someone in your family has already a team set in place. And it's good to reach out to them and ask for you know ask for their advice. But then again, you know, vetting, do all the vetting as much as possible. That will be one of the things that I would highly recommend. I see Carrie, you turned the camera on.
Yeah, I just have one thing to add to that. So a lot of times I'll go to the company's website, and if they have a DEI page, which a lot of companies, great companies do, like we have our DEI mission on our website, like I see a lot of companies do. And in addition to getting to know them, don't hire them if you don't like them, if you're not comfortable, what Milton said, check out their website. You find a lot there, or like you said, his LinkedIn page. I'll turn my camera back off now.
You can keep it on. Go ahead. What's the next question, Andrea?
So the next question is, are there any recommendations for budget management tools?
Yes, but before I answer that question, is the Better Business Bureau? It's actually the government website where you can actually go and look up and see, you know, look up any business. And if there's anything that, you know, people are reported them, you'll be able to see there, everything in there. So my apologies that I just couldn't put the name together, but it's the Better Business Bureau. www.bbb.org is where you want to go. And as far as budgeting tools, there are a lot. That honestly, there are a lot. You know, especially nowadays with technology pretty much taking over everything. You know, you can search for them on your depending on what operating system you have. If you have an Apple or if you have an Android phone, on the Google Store or the App Store, you know, that's definitely you can find those in there. I actually am a little biased. I mean, the one we share here is actually the one we have on our website. So if you want to get a really great something basic, but it has everything that you need to put together your budget, just go into our website. Carrie, if you don't mind sharing the link to our website that has the budgeting tool. You know, we'd be more happy to share that with everyone.
Okay, the next question is, currently, how many years do people live after activating their long-term insurance policy? How much are typical monthly costs for nursing home care?
Ooh, that's another excellent question. Kim, you wanna go ahead?
Sure. I was just going to say that I just had an aunt who fell and she lived on her own and she is now in a nursing home. And I believe my cousins told me, and this is here in the Shenandoah Valley, I'm sure it's different everywhere, it's $10,000 a month. As far as the question about term insurance, you're going to get it for a certain amount of years. If you outlive that term insurance, most times you can maybe reestablish another one. I'm not real positive, but I know most actually have term and whole. Usually if you outlive it, you can roll it back into another term policy, just not for the length that you had it before.
Yeah, and I will piggyback to what you were saying, Kim, in terms of the nursing. Obviously, it truly is there is a difference, right? When you talk about the nursing care, that is always it's going to be definitely a lot more expensive. I mean, you're talking about over $100,000 per year, and that's just the average medium. But it all depends on where you are. It really depends where you are. We know if you're in a city like in the West Coast, San Francisco, which has the highest cost of living, think about Boston, New York, even that us here in the Washington D.C. area, that cost might be way more than the median right now. But the price again, I would say anywhere between $250 to $300 a day that a person it is currently paying right now for nursing. And so again, it's very, very pricey, and is one that again we must prepare for right now, regardless of how old you are. I mean, this is one of the things that I always tell everyone. You're never too young or never too old to start saving for retirement. If you haven't started a plan yet, guess what? Today is the day, regardless. So that is the one advice that I always like to share with everyone.
And I believe that this is the last question. What is the ideal consolation? Yeah, consolation or investment commission by an advisor in terms of percentage of investment?
That's another tricky question, and the reason why I say tricky is because just about every firm they will have different pricing. Some of them they will charge you a flat fee regardless of your investment. Others they charge you based on how your return is doing. So if you have a great return, then they will assess their fees based on how well you're doing. So again, going back to what we were saying at the beginning, we recommend that you do your research. But normally, if you talk to firms that are a little more private, a little smaller, those probably tend to give you a much better pricing when it comes to to the fees that will be assessed, versus you going to one of those big names. And again, I don't want to name any of them just because I don't want to get in trouble. But I can think of right now, right off the top of my head, I'm thinking about 3 or 4 companies that are pretty. That's all they do for. I mean, you see their names everywhere, anywhere in the U.S. So again, it really, you have to do your due diligence. You have to do your homework. But again, have those conversations up front. Ask about those fees, because again, if somebody's going to charge you a 3%, a 5%, that is money that you can perhaps be pocketing if you were to explore somewhere else. So again, do your research. Consult with your peers, consult with your colleagues, family, friends, anyone that it's already in that environment, that might be able to guide you, and give you a better insight as far as help you save with the costs and all those fees that are associated with those type of investments.
So we have one more. Can we go back to the last question? So it was not in terms of insurance, not term insurance, but long-term care insurance. So the full question was, was it this one? Yes, no. Sorry. Currently, how many years do people live after activating their long-term insurance policy? How much are they typical cost for a nursing home? So when we talked about it, it was in terms of term insurance and not the long-term care insurance that
Long-term.
was asking for.
That might be one of those questions that we probably might have to get back to you. So we can probably reach out to Michael. I see Carrie giving me that okay on that.
Yeah,
Go ahead, Greg.
Michael, I can put his screen back up, but he talks about long-term care insurance all the time. Like, I feel he's really knowledgeable on that. And if you just want to call him up and ask him your questions or send him an email, tell him to call you, you guys can have a nice long discussion about it. He seems really passionate about that topic in particular because, well, I've worked with him a lot, and then also that was covered in a webinar a couple of weeks back. So that might be helpful. I'll put the slide back up, but Eddie, will you throw Michael's contact info in there? What happens when I ask Michael questions on important topics like this? I'm the third person in the middle. I would say go right to the expert. He's good at that, and he's so friendly. You'll really like him. But I can also go get him if you want. If
And
you're
then we do,
comfortable calling him.
no, we do have one more question. Are you saying that we should purchase term insurance instead of a whole life?
So no, not at all. I was saying that I have both. I have term and I have whole life, and that's just a decision that my spouse and I chose to get for each other. That's where a financial planner like fellows like Michael can come into play and help you discern what is best for you. Absolutely. I was not insinuating that also. I'm sorry if that's the way it sounded.
And I will whatever you say, Kim, because I also myself I have both. I have whole life and I have both of those insurance policies for myself too. And not that I'm trying to age myself here, but I'm not even in my 40s yet. But I have two little ones. I have a mortgage, so I hope, based on what my financial advisor has told me, that so far everything, I will be in good shape. So God forbid something was to happen to me. So, but again, the more you have, the more the merrier. Is what I always say. So, and know your situation too, right? I mean, that's one of the things that I always like to throw out there, especially when you're in the market, when you're shopping for different life insurance policies, where it's whole life, where you're talking about short term, long term. It really you had to do your own research, but the best thing to do again is to consult with a financial expert. This is the information for our colleague here, Michael Schimmel from Fellows Financial. And the cost for you to sit with him and have a conversation, it's completely free. So you don't have to pay to have a consultation with Michael. And so highly encourage you to start making those conversations. The other thing that I also want to highlight, and mention something that was covered in this presentation. Let's make sure that we prepare, we plan ahead. If you don't have a will, or if you don't have a trust in place, this might be the time to have those conversations. And again, it truly it can come in handy, especially if you're like in the position that I'm in, where I have two little girls at home. Then I want to make sure that they're protected, and that everything it's in order, should something was to happen to myself. So just wanted to leave that in there as well.
And I believe that's all the questions. Those are all the questions I
We have one more question on the chat and on the Q&A, and I'd be glad to read it. It says, and then before we go to the next question, to Kim's and Milton's point, I even Carrie mentioned it. That's the reason why we have these financial advisors, for you to ask these specific questions, especially because everybody as individuals, as couples, and as families, we all have different goals that we want to reach, whether it's early retirement, maybe purchasing a home, depending where you are with your life, we all have different goals, and there's different ways that we would like to approach that. So that's the reason why we encourage you to take advantage of all the services that we have, especially with somebody like Michael, that he has that experience and he's licensed to give you investment advice. So please make sure you take advantage of that. And also to emphasize, it's private. Whatever you talk with your financial advisors, that's between you and them. The United States Senate Federal Credit Union does not get that information. So please make sure that you take advantage of that. And we do really appreciate all these questions, because I mentioned it before that, you as the attendee, you're learning something new, but also as the panelists, when you ask these questions and you pick our brains, we also are learning something new as well. So thank you very much for all these questions. And the question goes, is paying down high interest debt by cashing out 401k early and pay fines a better strategy, especially when 401k returns these days are less and interest is high? So let me know if I need to read it again or if that makes sense.
No, Eddie, but I see Kim came off mute. So Kim, if you want to take it, I'm very passionate about this question. So, but I'll let Kim go first. Go ahead, Kim.
Thanks. And you just chime in. I have a coughing spell, so I do apologize. That's why I turned my camera off. So this is a little bit tricky. In some cases, it makes absolute sense. I want to preface this with, we are not tax advisors. We are not licensed tax advisors, so we would never give tax advice. But you're really going to want to weigh out your pros and your cons. You're going to want to, if you're under the age of 59 and a half, that's that key age, you may have a 10% penalty. If it's a traditional IRA, you're going to have to pay those taxes. If you call fellows, I'm going to say 99.9%, they're a financial advisor is going to say not to do that, because you're reducing your retirement funds. And that's what this webinar is all about. It's increasing those funds. So I know that was kind of a vague answer, and Milton, please feel free to chime in, but that's the best I got on that one.
Yeah, no, I'm not that I'm trying to put myself in Michael's shoes, but it's just one advice that I mean, and again, this is just my personal opinion on this particular answer. But my answer would be no. Do not touch your 401k, especially as Kim alluded to, if you're not at that age where you can actually make withdrawals, because if you do, you're going to be paying those not only are you paying the penalties, but you're also paying that 10%. On top of that. So don't. I mean, your 401k should be there just for retirement. Now, a couple of options that I will give you instead of cashing out. A lot of employers, believe it or not, maybe some of you may know this or may not know, but there might be an option where you can actually perhaps take a loan against it. Do a loan against your 401k, where you'll be able to, use, X amount of money, and then use that to pay down your debt. And you'll probably be paying an interest to it, but it will be very minimal. It will not be, outrageous rate that you normally see. But the other thing too is that, and then this is one of the reasons why we're doing this, is that, your credit union, us here at the United States Senate Federal Credit Union, we actually provide debt consolidation loans. So reach out to us, talk to us, and see what we can do for you, instead of you going into, and diving into your retirement, all the hard-earned money that you've been saving for X number of years. So instead of doing that, again, I will say that should be your last resource. If you already exhausted all of the other options that I stated, one, look into do a debt consolidation loan. That would be my number one recommendation. Two, see if you can do a loan against your retirement account. Again, those are two very great options that you can look into before you dive in and take those hits, right? Pay those penalties for early withdrawals and pay that 10% to Uncle Sam that, believe it or not, he's going to come after you if you don't pay that 10% fee whenever you're making those early withdrawals. So that would be my my honest and personal opinion. And again, when I say that I'm very passionate, I really mean it, because I hate for you to pay those fees up front, where it's something that perhaps you have been working so hard and spend so many years to trying to build your retirement. And I would hate for you to start diving into it, dipping into it, and be penalized just because you're not at that age. So that is my answer to that.
The United States Senate Federal Credit Union is proud to say that this is an organization that's people helping people. And to point out what Milton was saying, to talk to us, to contact us, let us know what your vision is. Let us know where you want to get, where you want to go, where you are, what you're struggling with. And best believe that we will find an answer for you. We have all these amazing products and services. As you can see, you can call 800-374-2758. And then, one of our representatives will be glad to talk to you. Thank you, Milton. Option 7, if you want to talk to that beautiful image right there. Oh, wait, it's Kim, but she presented this evening. So see, you're not talking to a machine. You're not talking to a robot. You're not talking to ChatGPT or anything like that. You're actually talking to a human being. So just let us know what your goal is, where you want to head, where you're going, what you want to accomplish. And, we will give you the resources. And this is the reason why we do these presentations, because we don't know what we don't know. But if you let us know what you want to do, best believe that we will find an answer for you. And that's what makes the United States Senate Federal Credit Union differently than other organizations, is because it's actually people that have been through your same struggle. We had the same questions that you did. Maybe we already accomplished something that you want to, or maybe we're not. We go in different directions, but you can learn from our experience and we can learn from your experience as well. So, and again, you can see Kim's information, KimberlyF@ussfu.org. You want to talk to Milton, you see his information as well. And also somebody, a couple of people on the chat were saying thank you very much for this presentation. We want to say thank you for being here with us. Thank you for giving us the time of your day, to learn something new together, because as you can see, us as, the presenters learn something new, and you as the attendee learn something new as well. And with that being said, Carrie, what is the topic for next Wednesday? Because I know you know these webinars by heart by now.
The topic for next Wednesday is financial readiness, how to prepare for a transition. So career change, divorce, new baby, a new home, all that stuff.
All right. And as we know, life is all about, curveballs and surprises and things that come unexpectedly. So like Carrie was saying, please, you see all those areas that she was talking about: divorce, marriage, having a new baby. Milton just went through, that transition with, with Fernanda, with his new daughter. And he can give you advice on that. And best believe that he gives the best advices in life, because I have learned so many new things. Like he was saying earlier, I'm taking notes as well, So it's one of those things that we're learning from each other. But we're so proud to say that we are glad that you are our member. If you're not our member yet, please check us out. We always have new promotions for new membership. With that being said, any closing regards, Mr. Milton?
No, Eddie, I think you hit it. You hit everything that I wanted to touch. So thank you all so much again for being with us, and we look forward to having you back again next week. Same time, same channel.